Most often what happens is, since we don't market directly to our clientele, they'll come knocking on your door or any kind of asset-backed lender. And what typically happens is the lender responds, hey, we like your business. We like the asset, whether it's AR, equipment, inventory, what have you. But because of all the existing liens, their response is, we're not going to lend you a dime until you hire Rob Schwartz and company to clean this mess up.
Welcome, everybody. Thank you for joining us today on the Construction MF'ers podcast. I'm excited to introduce to you someone who we've met probably 3 or 4 years ago now. We've referred some clients back and forth, and I've come to like a lot. I appreciate his feedback, and I utilize Robert for a lot of our clients, sometimes just to educate myself to understand some things. But Robert Schwartz, he is the founder and CEO of Metro Capital. Welcome to the show.
Thanks, Scott. Great to be here.
Thanks, man. Hey, let's just jump right into it. Robert, tell us a little bit about yourself. Take a couple minutes and explain who you are and Metro Capital and where you guys started and what you really do. How do you help the community we're out there now?
Sure, I'd be glad to do that. I'm obviously not a spring chicken, so I've done any number of things over the course of the past 40, 45 years. I originally started in the collection business, went back to school, worked in real estate for a while until that crashed in 1989. And then went back to my original knitting, if you will. And I founded this firm right around 1999 when the subprime cash out mortgages were a big thing. And I had contacts at all the major consumer debt collection companies, and I would create conduits between them and one subprime mortgage lender in particular, where they were trying to collect debts, and the only source of funds to pay those debts was a cash out subprime refinance.
This is for their personal mortgages?
Yes, this was a totally consumer business at the outset, and it worked very well. You'd have situations where people owed $50,000, $75,000, $100,000 of credit card debt primarily, other kinds of debts as well, medical, garage door opener, contractor. But it was mostly credit card stuff. And we did this for a while until the mortgage lender that I was using on the other end of the conduit came to me and said, hey, we love the business you're bringing us, but it's created a problem. Even given the absurd underwriting that they were doing at the time, these people would still only have $50,000 of lendable equity when they had $75,000, $80,000 of credit card debt. And nobody wanted to refinance their house and still be left with $40,000 of defaulted credit card debt. So as they explained it to me, I had essentially created a problem for them in that they pay their loan officers to source and close loans, but now they were spending a significant part of their day haggling with creditors to make it fit in the envelope. And they basically said to me, you created this problem. We want you to solve it. So I created a little outsourcing company, basically to do nothing but negotiate with credit card companies to resolve these issues. And almost overnight, that became the bigger business than the conduit business. So I canceled my exclusive contract with the one particular mortgage lender and just took it nationwide. And it was a really great business. Every deal was pretty much the same. The fees were great, but relatively modest, although the volume was high. But after a year or so, I realized there was a commercial application for this, and I started to dip a toe. And over the years, we did just a handful of commercial engagements. But then come 2008, late 2007 rather, the subprime cash out mortgage business literally imploded and it was gone. And the consumer part of our business literally evaporated overnight. And we were left with nothing but the commercial side of the business. And that's what we've done ever since.
So that was the birth of the Metro Capital that is today.
Yes, correct.
So
Like right at the beginning of 2008.
Yeah, so let's talk a little bit about today then. So Metro Capital is founded from obviously an idea that you had for consumers. It turned into a business. That business then lost the liquidity source of the subprime mortgage crisis, which we all lived through. So now you have this great consulting business. You've learned all these skills to be able to negotiate with creditors on behalf of your client, in this case, the business owner, right? Or an individual. But now it's really, since the subprime crisis, these are all business owners with business debt. So
we do no consumer business whatsoever any longer.
okay. So how does someone, when would someone want to come? What problem? Now, here's the best way to ask you that. What problem does your typical customer have that they're trying to solve in order to figure out to come to you?
Well, it always revolves around debt of one sort or another. Primarily, we're dealing with MCAs and accounts payable. That they have significant numbers in that 91-day plus column, and because of this is being typically exacerbated by the MCAs, they simply do not have enough cash to make ends meet. Their AR is slow. Their vendor relationships are becoming difficult. And every day, the MCAs are hitting their account for their draw. And they just don't have enough cash to meet payroll, to buy the goods and services they need to run the business. So most often what happens is, since we don't market directly to our clientele, they'll come knocking on your door or any kind of asset-backed lender. And what typically happens is the lender responds, hey, we like your business. We like the asset, whether it's AR, equipment, inventory, what have you. But because of all the existing liens, their response is, we're not going to lend you a dime until you hire Rob Schwartz and company to clean this mess up. And that's how it happens.
So client calls you. What's the first step? What do you do? What's the first step for them, and how do you guys go about doing it?
Well, the first step is to just give them a very brief overview of what we do here and how we operate, and give them a sense of confidence that we act in an entirely ethical manner. We're not about soaking them for upfront fees or putting funds into escrow accounts, etc. And then we just listen. I want to hear the story about the business, what events brought them to this situation, and where they see the business going in the future. And this will be a 10 or 15-minute conversation. And if I have some reason to believe that we can be of assistance, we will send them our document request. And that's really just what you would expect it to be. All the financial data, balance sheet, P&L, aged AR, AP, debt schedule, personal financial statement, if that's an issue because of the personal guarantees associated. And most importantly, a cash flow forecast, something even net of the MCAs or other items, so we can see what kind of cash the underlying business is throwing off. And from there, if we can see if there's enough cash being generated by the business, that gives us a level of confidence we can create a path to get them from where they are to where they need to be. Because we're a contingency-based organization, if I can't see that path, that's an engagement we're not likely to accept. But if we can, I'll probably follow up with some additional questions, but at some point we will tender an engagement letter. And as long as they're comfortable with the terms and conditions, they'll execute it, I'll execute it, and then we're off to the races.
All right, so let's go through a scenario. I'm
Sure.
a business owner. I've got one or two, three merchant cash advance loans or MCAs.
We've seen them up to 12.
12.
Yes.
I'm going to table that for a second because I'd love to know what the conversation's like when you call the 8th, 9th, 10th, 11th, 12th lender in there, and they have to imagine there's a problem. But that's part two here. So, but just from a customer perspective, I really want to take someone through this journey because this is a real problem. People are feeling these problems. They experience them every day. More often than not, in my experience, someone didn't intentionally do this to themselves. It was sort of an accident, and then they didn't understand what was happening. And next thing you know, they're in the scenario. So now we have someone in this scenario. They have 2 or 3 merchant cash advances. They went into them thinking they were going to be helpful to them. They now realize that it's hurtful for one reason or another. It's impacting their AP, it's impacting their business, it's impacting their payroll. They come to you, they explain that scenario, and you tell them, hey, I can help you. Great, awesome. I'm now that customer, Robert. How are you going to help me? What are you going to do?
Well, we have a whole variety of strategies, techniques that we use, but we will immediately begin reaching out to the creditors and at a minimum modifying the terms of the advance. We see clients that their weekly payments in total are $10,000, $20,000, $50,000. We're going to immediately cut that quite severely, maybe to 20, 25% of the contractual amount, while we dig further into it and try to see, is there a way for us to develop some liquidity that would either be able to pay off the MCAs and or vendors, or negotiate a settlement, whether it's paid out over a relatively short period, 60, 90 days, or even a longer period if we can justify doing so. And at the end of the day, the goal, when I say get them from where they are to where they need to be, that means their payables are under control and their MCAs are, if not gone, the payments are modest and the client can afford to make those payments until whatever amount we've negotiated has been fully amortized.
Gotcha. So what is the time frame that someone could expect to have this done? Their immediate painful point is now. When do they get a little bit of relief? When do they get a resolution?
Well, they get some relief almost immediately.
Okay.
MCAs are not the most communicative people when this is the topic of discussion, whereas they speak volumes when they're trying to put money in your hands. But typically within a week, we're able to ratchet down the payments significantly. And then we go from there and see what else can be done. We might negotiate a 4-week, an 8-week, a 12-week modification. And then sometimes we're just going back and revisiting it repeatedly over time. Other times there's a $50,000 balance with a $5,000 a week payment. We're negotiating that down to $2,000 a week, and maybe they're getting 30 of the 50,000. It depends a lot on where it is in the life cycle of the facility.
So let's talk about it from the lender perspective.
Sure.
So, in fairness to the MCAs, they made an offer to a business owner. The business owner accepted it. They provided their end of the deal, which is the cash that they promised, and everyone agreed to the fees. So now we're some portion of the way down the road, and I'm a lender, and I'm getting the call from you. How do they react to it? What is the feedback you get? Like, what are they trying to accomplish?
Well, it depends. but mostly on whether we've actually interacted with them before. We have a reputation in the MCA industry for dealing in a very much ethical manner. So if it's somebody that we haven't dealt with before, they're hopping and mad, and I'm listening to 5, 10, 12 minutes of them yelling and screaming until they've kind of exhausted themselves, and then we talk them down off the ledge. If it's somebody we've dealt before, we've already gone through that process, so we don't need to do it again. But the reality is, while they, let's call it in good faith, put out these funds, it's now a situation that's unsupportable. And if we can't get everybody rowing in the same direction, there's a real possibility that everybody can just simply get blown out of the water. It only takes one lender that has a lien position, and it doesn't matter which lien position it is, to start filing lien requests on every bank that's, excuse me, every bank in a 50-mile radius of the client, leaning credit card processors if that's part of their business model, even sending lien requests to their customers, directing that any receivables that are owed to our client be directed to the MCA lender. And the result of that is just implosion of the firm.
Right.
You cannot cut off all of their cash and expect them to continue to operate.
So how do you prevent that from happening?
Well, we're highly skilled at what we do, and the initial call, at first, we're merely explaining to them that this represents an existential threat to their merchant. It's not necessarily their facility, it's the combination of all the facilities and the vendor problem. If they can't get raw materials, they can't operate. So the first goal is to get everybody to understand the gravity of the situation, and we're either proposing something in that initial phone conversation, or we're just putting them on notice that they cannot pull their payments today, tomorrow, or the next day, because the funds won't be there. And we will be back to them very shortly with a plan. And
So
then
how long does it usually take from start to finish for that conversation to be had, the analysis to be done? You know, if they're getting some immediate relief, that's great. But ultimately getting to that resolution that we talked about, and through this process of communicating, which sounds very, not arduous, but it's certainly intensive on your end. How
absolutely, yes.
get there to ultimately come to an agreement, and then do you execute those agreements, or not execute it, but do you get those agreements prepared and put together and renegotiated and in writing for the client?
It depends. If it's a modification, sometimes this will be documented, especially if there's a lender that's coming in, a real lender such as yourself. Then there'll have to be a modification and forbearance agreement that covers all eventualities. And quite frequently, there's a subordination to the new lender. And that can be quite tricky, as you imagine. Getting somebody who's now in a first lien position to subordinate to you or some other lender. But part of our art is making them understand that everything we're asking them to do is in their best interest. How long does it take to get the initial agreements in place? That actually happens quite quickly, depending on the number of facilities, a week to 2 weeks. But these may be relatively short agreements out of the box. And then as we move through, we're negotiating something longer term.
So explain for us and everyone listening, who's a typical client? What industry are they in? What size is their business? What's a typical client for you?
Well, we're actually agnostic as far as what our clients do. We tend not to see a lot of retail operations. Most of our clients are B2B or B2G, and they're small to lower middle market companies. I'd say mostly in that $2 to $30 million revenue range. And we do see a lot of construction business, but we've seen everything from flooring wholesalers to stratospheric tech companies that we literally do not understand what it is they do. But finance is finance, regardless of what the product is. And so the process doesn't really change. It's not necessary for us to understand what their product does, geolocating, text messages, what have you.
So
So
go ahead.
I was just say, I mean, if you can think of a type of business, we've probably worked with them. It's
What I'm gonna
been
ask next is that,
15 years now.
if a client connects with you, what is the
Mhm.
best thing they can do to help you help them? And what are some things that they should avoid doing?
Well, they should absolutely avoid having any further contact with the creditors once we've been engaged. We get power of attorneys from our clients, and if they're speaking to the creditors, there's absolutely nothing they can say that's going to make our job any easier. And there's a whole world of things they can say that would make it more difficult
Yeah.
because they just don't understand our business. They may know everything about laying pipe or pouring concrete or whatever it might be, but they don't understand our world. So that's the single worst thing they can do. As far as what they can do to help is to be responsive to our requests for documentation. We're essentially a contingency based organization, but we do get modest retainers because we've learned that having just a little bit of skin in the game from the client is the difference between us getting a document we need in an hour as opposed to 10 days.
Yeah.
And when we're in the thick of this, time is always of the essence.
Moving fast definitely makes a big difference.
Absolutely. Yes.
So onto pricing, retainers. What does it
Mhm.
cost a typical client to work with you? How do you charge those costs and collect those costs?
Well, as far as the retainer, we never take more than $2,000. And generally the range is 1,000 to 2,000. Again, it's just this skin in the game idea. Beyond that, our fees are generally anywhere from 25,000 to 200,000, and that's obviously dependent upon the amount of debt they have when they come in and what kind of execution we get for them. And all our fees are predicated on formulas. It's not a subjective thing.
Yeah.
If we're negotiating a settlement, we charge 25% of the amount we save them. So if we settle with the creditor for 20 cents on the dollar, that's the point at which they're paying us exactly as much as they're paying to their creditor. But they understand that they want to pay us as much as possible because every dollar they're paying us means they're saving $3 on the cost of their debt.
But
It's
they
just the
pay that.
arithmetic of it.
How and when do they pay that amount to you?
Well, one of the oddities of our business model is aside from the retainer, we don't get paid anything else until the project is completed. We've got all the agreements in place, settlements have been paid or are about to get paid. Long-term modifications are in place. And once that point's reached, we will send our client an invoice and it's earned at that moment. But as a practical matter, we essentially become yet another unsecured creditor to a distressed company, albeit one that's in much better shape thanks to our efforts. And it sounds almost insane to have that business model, but as a practical matter, in all the years we've been doing this, there's only one situation where we got stiffed on a fee. And partly because our clients are uniformly so grateful for what we've done for them, but also we're not killers. It's not unusual for our clients to take 3 to 18 months to pay off our invoices. We generally carry a very large volume of accounts receivable relative to our size, and people are just paying it off weekly, biweekly, monthly.
And so are they kind of paying you at the same time, or paying your fees at the same time they're paying off their creditors? So it's kind of in
Yes,
line with
sure. Yes, that can happen.
so
Sometimes it's after the creditors have been paid off. It depends on if we're talking about long-term modifications, we probably will get some of our fees while the MCAs are still extant. But if it's settlements and every dollar of liquidity has to go to pay those settlements, we're not going to see anything until after those MCA facilities have been entirely retired.
interesting. So are there any situations or scenarios where you would decline to work with a particular client? Like the scenario is just too something, too good, too bad, too this, too that. They're different.
Yeah, they're absolutely. In point of fact, we probably only accept about 35%, give or take, of the engagements we're shown. And more often than not, it's simply because I mentioned earlier being able to divine this path from where they are to where they need to be. And some clients, some potential clients, their business plan, their situation is just so dire that we simply cannot see that path. If you have a $2 million business and your net margin is 5%, and you've got $1 million worth of debt, there's we can settle. We have settled for as low as 20 cents on a dollar. We cannot settle for 3 cents on the dollar. It just can't happen. There's a level below which the creditors will say, "Hey, let your guy go out of business. We'll take the hit."
And is there a scenario, for you guys that, Robert, is that like you have to maintain this balance of relationships between your client and these lenders? I mean, obviously, when this lender sees your number, they're probably not that excited about it, right? But do you have
Well,
good
that's
relationships
actually not
with
true.
lenders? Yeah, that's what I was curious. Like, do you
Yeah.
have good relationships with them, and does it? How
It's
do they?
still somewhat adversarial, but this may come as a surprise to you. We actually get a fair amount of referrals from the MCAs. They
Interesting.
know when their clients are in trouble, that they're missing payments, they're attempting to negotiate modifications on their own. And the MCAs know, because they can do a lien search in a heartbeat, that they're one of 4, 5, 11, however many MCAs. And that as such, they know the only way to work this out is by having somebody that can coordinate efforts with all of the creditors, which
Interesting.
they cannot do themselves. They have a fiduciary responsibility to their investors. So they call us in because they know we're ethical, I don't know, brokers, whatever, that can get everybody rowing in the same direction
Yeah.
so that everybody's equally unhappy. And
Yeah.
nobody's getting blanked. Nobody's getting 100 cents on a dollar.
Interesting.
So yeah, that we have actually very good relationships with a handful of MCAs. We have solid working relationships with most of them. New ones crop up all the time that we don't know.
Yeah, and we're running a little out of time, so I have a couple last minute questions I want to ask of you.
Sure.
Do you guys have attorneys on staff, and do you work directly with attorneys, or how do you negotiate these? Do you
We
need?
have our own counsel, just as any business might. We do not have attorneys on staff.
Okay.
That said, we do use attorneys on occasion. We have relationships with attorneys in many states. I'm not certainly not all, and we will use them as an adjunct to our process. we will engage them, not the client. We will engage them, and we'll have them put together the schedules and simply show them what it looks like were they to find themselves in a Chapter 11, Subchapter 5 situation.
Perfect.
And we don't like doing that. It's an extra cost to us. There is an aspect of ultimatum involved, and we don't like issuing ultimatums. But generally speaking, once they see those documents, they realize that what we're offering them is actually a far better solution.
Perfect.
And we have attorneys working on engagements with us on a constant basis.
And I assume
Not every engagement, of course, but
and I assume you can work with clients' attorneys too, helping them in.
oh, sure.
Perfect.
We have, but generally they don't want to be involved in this because they're contracts people. They're not negotiating
Right.
type attorneys. They're not litigation attorneys. That nobody has one of those on staff or as outside counsel. They're people that are involved in corporate structure and negotiating contracts with clients or vendors or what have you.
Well, Robert, I really appreciate you taking the time to join us, talk about your business, talk about the problems you solve, and some of the solutions and creative solutions that you've come up with. I really appreciate it. I think it's, the spirit of what I'm trying to accomplish here with this particular show and you as a guest is to let people know there are other options out there. You don't have to go into bankruptcy. You can actually negotiate with people, even if you get yourself in some of the worst situations or tough ones, that there's other pathways. And I think you're a good option for someone to speak to, consult with if they are in that spot. And, look, we've seen a lot more things happen here in the last 6 or 7 months ourselves inside the mobilization funding business. And I've had even people reach out to me directly on LinkedIn and ask for my help or thought or advice, or do I know anyone? So I thought it was a great opportunity to bring you on. I think you're certainly a great pathway for someone to talk to think about, and to understand. And I just really appreciate you taking the time to come in and explain what you do.
Well, it's our pleasure. And we're very grateful for the opportunity to spend some time and tell people about the Metro Capital story. We're very proud of what we do here. Our mission is to save jobs and preserve shareholder equity. And really nothing else matters if we can do that, that there's no file too small or too large, that if we can see a way to do that, we will absolutely do it.
Well, one thing I can tell you for sure is there's a lot of people in your world doing the same thing or trying to do the same thing, and they're in and out of the world very fast. And so
Sure.
Anyone that's been doing anything for the better part of 30 or even almost 40 years, there's something to be learned there. There's value to be given, and nothing lasts that long if you're not doing the right thing. So I give you some credit for that. You should.
Well, thank you. We're very proud of our track record.
Yeah. Well, everyone, thank you for joining us. I hope you like this episode of the real Construction MF'ers. And if you like this episode, please let people know. If you can comment or have any advice or things you'd like to see in the future, please let us know that too. And in the meantime, God bless you all. Hope you all have a great day. Robert, thank you again.
Thank you, Scott. Appreciate your time.
You're welcome.